Welcome to Bull and Bear Markets, another view. This is Frank Armstrong. I'm the president of Investor Solutions, Inc. and the author of The Informed Investor and the Retirement Challenge, Will You Sink or Swim? Because so many people are so concerned about their financial future in this dismal market, I thought it'd be a good idea to review past bull and bear market performance from another perspective. Bull and bear markets have been with us as long as we've had financial markets. There's certainly nothing new. While most of the best data we have dates back to 1926, we know that there were booms and busts throughout recorded history, dating back to the Revolution and even before. We've seen this movie before. The fact that we are in a particularly difficult economic and market environment doesn't reduce the validity of a long-term buy and hold strategy or the necessity to hold equities as a substantial part of your portfolio. We're all familiar with this chart. It illustrates the total dominance of stocks over safe assets. The line at the top is small companies. Next down is the S&P 500. And those little itty-bitty lines clustered along the bottom are Treasury bills, government bonds, and inflation. You can see there's no growth above inflation in the so-called safe asset classes. And that's before taxes. On an after-tax basis, they'd have been net losers. But the problem with this chart, due to the scale, events in the early years hardly even show up, and those little dips in the lines are not proportional to what people actually felt and experienced as time went by. This chart gives you the same information on the performance of the S&P 500, but breaks it down into bull and bear market periods. It clearly shows the duration and magnitude of the market performance from January 1, 1926 to October 31, 2008. Bear markets start on the first day of a market loss that continues until at least a 10% drop and ends on the last day before recovery begins. So of course, you couldn't have known about this until after the fact. After all, who knows when the bottom occurs until after it's happened? A bull market is defined by data points not considered part of a bear market. In other words, everything else. The rising trend lines in blue designate the bull markets occurring since 1926, and the falling trend lines in red document bear markets. The bars that frame the trend lines help to describe the length and intensity of the gains and losses. The numbers above and below the bars indicate the duration in calendar days and cumulative return percentages of the bull and bear markets. For instance, the first arrow shows the market volatility surrounding the Great Depression. And this market shows the rather horrible market around 1973-74. This arrow shows you the crash of '87, where the market lost over 20% of its value in one single day. Almost 2 years later, we had another crash in '91. This is the far more serious tech wreck of 2000 to 2002, where the market lost cumulatively 47%. Also includes the period of time from 9/11 and the destruction of the World Trade Centers and the period of time that Wall Street closed. Finally, this is the beginning of the current market unpleasantness, and if we extended it to today, it'd look even worse. Keep in mind that these graphs don't show total compound returns or growth of wealth since 1926. Once the cycle is established, in retrospect, the first day of that cycle resets the performance baseline back to zero. This is the same chart, only with monthly data. The market cycles are identified in hindsight, applying the same methodology as the other slides we're going to see in Bull and Bear Market series. Monthly index returns are total returns, which do include reinvestments of dividends. Russell 2000 is the domestic small company index. This graph documents the bull and bear market periods in the Russell 2000 index from January 1979 to October 2008. Small company stocks went through time differently than large companies, but exhibited even higher total growth. This graph shows bull and bear market periods in the Morgan Stanley EAFE, or Europe, Australia, and Far East Index from January 1970 to October 2008. EAFE is a good proxy for foreign, developed country, large company stocks. These returns consider the reinvestment of dividends net of foreign government withholding tax. All monthly observations are performed after the fact, just like the other charts. Finally, this graph documents the bull and bear market periods in the Emerging Markets Index from January 1988 to October 2008. The market cycles are identified in hindsight, applying the same methodology as the other slides. The market index data returns include reinvestment of gross dividends. Back to the S&P data for just a second. You can see intuitively that there's a lot more growth during the bull markets than there is loss during the bear markets. The average duration of the bull markets was 413 days, while the bear markets was only about half that, or 217 days. The average return during bull markets was 58%, and the average loss for bear markets was 21%. This chart shows rolling 120-month annualized returns, or 874 periods in total. The leftmost bars, S&P 500 index in blue, 1-month U.S. Treasury bills in red, show the annualized returns from January 26 to December 35, 120 months or 10 years. The next bar shows February 26 to January 36, and so on, to the rightmost bars showing the annualized return from October 1998 to September 2008. The chart shows that for all 10-year periods in the past, the S&P beat Treasury bills in 751 out of 874 total periods, or 86% of the time. In many of those periods, the S&P return was substantially higher than Treasury bills. Stocks have generally rewarded investors with higher returns for their higher risk. Investors seeking safety of T-bills could miss the opportunity to capture the higher returns of stocks. So, what can you learn from this? First, markets always recovered after a bear market. The value of the world's markets continues to increase over the long haul. Next, since 1926, bull markets in the S&P 500 index have lasted longer than bear markets and had bigger gains than the bear market losses. And fluctuating performance within each trend illustrates that the volatility and the uncertainty occur even within well-established market cycles. Bull markets may have short-term dips, bear markets may have short-term advances. The immediate trend is not readily apparent to market observers. In fact, you may become clear only in hindsight. That's why it's so hard to accurately predict and time market cycles. Finally, the graph suggests the importance of maintaining a disciplined investment approach that views market returns and trends from a long-term perspective. Occasionally, bear markets last for a long time. As you're going through it, it can seem like forever, and then you can believe that it's never going to recover. If you lose faith, you won't be there when the market inevitably does recover. Investors who react emotionally to short-term movements are at risk of making ill-timed decisions that compromise your long-term performance. The case for having the appropriate exposure to the world stock markets is as strong as ever. But success in stock market investing requires discipline and the fortitude to ride out the occasional bear markets. Investors get paid to endure these risks. If stock market returns were certain, they wouldn't offer the long-term returns that they do. Earlier, I mentioned that we've seen this movie before, and it's always had a happy ending, but you have to be there to enjoy it. Thanks for joining us today. If you have any other questions or concerns, please contact your advisor here at Investor Solutions. We're always here for you.